Thomas Gomez here to talk to you about project number 2 for Finance 695 for Johnny Finance's class. We started out with 23 companies, mostly local companies, some non-local companies that were either companies that classmates worked for or competitors of those companies that our classmates worked for. I originally looked at 23 companies and narrowed it down to 5. I was able to narrow it down to 5 pretty quickly just by looking at canceling out companies with low ROEs, very low ROAs, extremely high equity multipliers, negative economic value added, and other major red flags. Once I got it down to 5 companies, these are the 5 that I picked. It's 3M, CF Industries, Marathon Petroleum, Pool Corp, and Albemarle. Once I got it down to these 5, then I had to take a deeper look and start looking at what was driving some of the numbers, such as the ROE, what risks were associated with these investments, along with which way were these investments trending, whether up or down. It's great to have large numbers or good numbers, but you also got to take into account which way those numbers are moving on a year-to-year basis. Through all my research, I ended up liking all of these companies, but I could only choose one. I ended up choosing Pool Corp. Just a little background information about Pool Corp. Although it was started in 1993, Pool Corp didn't become a publicly traded company until 1995. It was started in Delaware, but now its corporate office is located in Covington, Louisiana. Pool Corp is the world's largest wholesale distributor of swimming pool supplies, equipment, and other leisure activity items. It has over 3,400 employees, over 300 locations worldwide, approximately 80,000 wholesale customers, and 160,000 national brands and private label products. You might think wholesale pool distributor is a very niche market or a one-sided market, but if you look at how many locations they have, how many customers they have, and how many different brands, you can see that they're quite diversified across the field. There's not going to be one specific product or one specific customer or one specific area or region that is going to hurt them if the market dips, or if that product is no longer available, or if that customer is out of the market. Since they have such a large range in this niche market, it's almost as if they're diversified inside that market. To start looking at their financial records, to explain why I chose them, we first look at liquidity. Now, one of the things that first jumps out to you whenever you look at the liquidity is you notice that the company definitely became more liquid after 2009. And you can see going from 2009, the cash ratio stayed about the same, just fluctuating slightly throughout the years. But the current ratio and the quick ratio definitely jumped up after 2009. And this is pretty common with most companies that I investigated. The next major thing that I noticed right off the bat was that the current ratio was so much higher than the other liquidity ratios. And this will just go to show you that Pool Corp has a very high product inventory. And normally you hear that too high of a liquidity ratio is going to be bad, but you can't just look at the numbers, you also got to look at the context. Pool Corp is a wholesale pool supply distributor. So naturally, as a wholesale distributor, they're going to have large quantities, very large inventories. So this doesn't alarm me nearly as much as the number originally did whenever I first saw it. Also, the cash ratio seems a bit low, which does raise a little bit of a red flag, but I'll show you later on in the presentation as to why I'm okay with having such a low cash ratio. You don't want to have too high of a cash ratio, or you're stuck with all this extra cash just sitting in an account not doing any work for you. You want your money working for you. After I looked at the liquidity ratio, I moved on to profitability ratios. So looking from 2007 to 2012, you can see the first 3 years of that time span, it's going in a downward direction, and it hits a real slump in 2009 on both the ROE and the ROA. But 2010, 2011, and 2012 It rebounded very nicely and is trending upward. It's nice to see such high ROE, and Pool Corp was one of the higher of the companies that I looked at. But another nice thing is to see that upward trend. You want to be able to find a company that's moving in the right direction. Pool Corp has both a high ROE and an upward trend, both in the ROE and the ROA columns. So these are both bonuses that it has upward trend and high numbers. After the profitability ratios, I moved on to the DuPont analysis to figure out what was driving those high numbers. Once you take a look at the DuPont analysis, you can see that, again, 2007, 2008, 2009, it was pretty highly leveraged company, a little bit more leverage than I would like to see. However, after that rough year in 2009, they became a little bit more liquid and they had less leverage, which I think is a good idea. You know, they came down to 2.74 in 2010. They jumped down a little bit further in 2011 to 2.65, and then they were back up to 2.76. So they jumped down from the mid threes to low threes to the upper twos, and they're kind of balancing out the past 3 years. Some people might view this 2.76 as a high leverage ratio or equity multiplier, but I think it's okay. It's definitely good to have that as a long-term investment. You want to have that equity multiplier doing some work for you, making some money for you. One thing that you will notice is that there's not a steady incline in the leverage ratio, meaning that steady incline in your ROA and the steady incline in your ROE are coming from both the steady incline in your asset turnover, or your total asset turnover, and your operating margin. This points to the business becoming more cost effective and managing itself more efficiently. This is very good to see for a company that it had a down year in 2009, and it started to tighten the reins and become more efficient and streamlined, it seems like, and that's what you get with that upward trending asset turnover and operating margin. After the DuPont analysis, I moved on to the economic value added. Now, this economic value added slide also shows the capital structure, and you can see that the capital structure for 2012 has zero short-term debt, and this is the reason that I was talking about why I'm okay with such a low cash ratio. Although the company does not have an excess amount of cash, they're not having to take on short-term debt to pay their bills. They have enough cash flow within the company to pay their bills on time. The reason that a company will take on short-term debt is not to buy something that they can't afford, but it's to pay bills that they haven't gotten around to getting cash flow for. So although the cash ratio is quite low, they're not having to take on short-term debt to pay their bills, and this is why I'm okay with that low cash ratio. Next thing you want to look at is that the economic value added here at 37.04. Anytime that you have a positive economic value added, you know the company is making the right decision by being in business. The economic value added takes into account a more true sense of profit. It takes the economic profit rather than just the accounting profit. So the economic profit takes into account the cost of borrowing money, or the cost of the capital that's being reinvested, or the cost of doing business and daily operations and stuff like that. If it was a negative economic value added, then the company would be better off investing elsewhere than inside the company, or continuing to do business. After looking and seeing the positives of the economic value added, I then moved on to the risk and volatility. And I have a beta graph here, and as you can see, Pool Corp is here on the y-axis, and the S&P index is here on the x-axis. Now you can see the beta hovers around 1.1, just below 1.2. This means that the volatility of Pool Corp is very similar to the S&P index. One of the reasons that I like this is because you get the high ROE, the high ROA of an individual company or an individual stock but the risk and the way that it moves is very similar to the S&P index. So you have that lower risk with that high reward and that high return on equity. As seen here, the slope of the line is close to 1. Next, I took a look at the price per share, the price to earnings ratio, and the earnings per share. I just took 2010, 2011, 2012 because those are the years that I'm focusing on when the company made that turnaround and is making that upward trend. Looking at the P to E ratio, the price to earnings ratio, you can see that that also increases all the way up to the current P to E at 30.65. Now this is a bit high for P to E, and some people might think that this means that the stock is overvalued, and it could be. However, the stock prices continue to rise each year all the way up to the current. Now, I went into Bloomberg and found the estimated earnings per share for 2013 and 2012, and you can see them here at 2.08 and 2.48. So I used that along with the estimated P to E ratios of 25.77 and 21.62 to calculate an estimated dollars per share or cost per share for the next 2 years. And as you can see, the price kind of sits close to 53.6 for the current price and the estimated 2 next years. This is some cause for concern, and it was just in the news recently that Pool Corp came out and lowered their estimated earnings per share for the 2013. It was up around 2.2, and now it's down to 2.08. So this does raise a little bit of a red flag. However, there's a lot of positives that show that the company's moving in the right direction. Finally, concluding about this, the things that I like about this company is the high ROE, the high ROA, and the upward trend for both the ROE and the ROA in the past 3 years. Some people might view this as a high leverage ratio, but I'm okay with the leverage ratio that they're at now. In the previous years, 2007, 2008, it was a little excessive. This comes down to personal preference. And as a long-term investment, as a young investor, I think it's a smart thing to have that kind of upper edge leverage ratio. It has a high current ratio, but like I said, in context, that's to be expected for a wholesale distributor. They should have a large inventory. It doesn't have the best total asset turnover or operating margin, but those are both heading in the right direction. I think if the company can continue to improve its efficiency and continue to trend upward with those, all other good profitability ratios will follow. The company has a positive economic value added, meaning that it's doing the right thing by staying in business. The weighted average cost of capital, or how much it's costing for them to get money and invest in themselves to do business, is less than the profits that they're making by doing business. The beta is close to 1, which means that its volatility or its risk is very similar to the index it was tested against, the S&P index, which is, in my opinion, a good thing. It's not a lot of risk, but there is a good upside with the ROE and the ROA. A possibility is to have a stagnant stock price. This is a little worrisome. However, these are just estimates and could be wrong. And also, you have all these other positive reinforcement that the company is moving in the right direction. So maybe this is something that you might want to watch for a year and see how the stock price fluctuates. Maybe it is a little overpriced right now, but the company's working towards that goal, that it eventually will catch up with that and even pass it up, in my opinion. Or maybe the stock price drops a little bit, then you can get into that investment and it'll continue to take off as the company becomes more efficient, operates better. And so it's not a sure thing, but in my opinion, Pool Corp is the best bet of the 23 companies we analyzed, and those are my reasons why.